Let's move on to IFRIC 19. This will be when a financial liability is paid with equity instruments being issued by a debtor. Important to identify that IFRIC 19 only focus on the recognition and measurement from the debtor's point of view, not the creditor. Therefore, when you look at my very basic example again on the right side of your screen, we will debit an asset. Let's say this is bank, right? Debit your asset, credit the financial liability, and this will be 100,000. Now, when the debtor issue equity instruments to the creditor to extinguish all or part of the financial liability, those equity instruments will be considered as a consideration paid. Now guys, if we look at extinguish, it's just to pay to clean the account. Now, how do we recognize this transaction? If, for example, the fair value of the issued equity instruments is 120,000, what will happen? In the records of the debtor, if the debtor fully pay or fully extinguish this liability, very important to identify fully, guys. I'm going to talk about this just now. We will have to debit the financial liability with 100,000. Take this out. Credit shares issued, share capital with 120,000 because that's the value. But what will happen with this 20,000, this difference? What do we need to do with this? We will recognize this difference in our profit and loss. Right, but what will happen if our entity only pay for a portion, a part of this not the 120,000, a part of the financial liability? Let me just repeat myself again. What will happen if the debtor only pay for a portion, a part of that financial liability? The debtor will have to determine if any part of the consideration paid relates to the modification of the terms of the remaining liability. And then you will have to refer to our financial instruments principles. Therefore, to recap the principles, the debtor will have to de-recognize, take out the liability. If you look at our journal, therefore, debit, take out the liability. The debtor will have to measure the equity instruments issued at fair value. Unless the fair value is not reliably measured, guys, then they use the value of the financial liability. If the debtor only pays part of the financial liability, we need to identify if there is a possible modification. Okay, guys. If yes, allocate the fair value of the consideration paid to the financial liability extinguished and the financial liability retained. And the debtor will recognize in profit and loss the difference between the carrying amount of the financial liability and the equity instruments. Identify, I did not include a number here, guys, because this will form part of my modification section. Right, guys, this is a recap of the IFRIC principles. I hope that this video has helped you.